Hi everyone! July is coming to an end while the earnings season is in full swing. So investors are now extremely nervous. This week the Fed will hold a two-day meeting and make a key rate decision. The regulator will also reveal the new economic projections and plans for monetary policy taking into account the current economic situation. This week is rich in events. Such top tech companies as Apple, Alphabet, Microsoft, Meta, Visa and ExxonMobil are going to unveil their quarterly reports. Apart from that, US GDP data is on tap. This is why traders are so anxious. Despite some sharp swings, last week was rather calm. Although the main US stock indices closed with the week in the red, they managed to rise on Friday. Let's discuss the main events of the stock market in detail. Subscribe to our channel and keep your finger on the pulse. You are also welcome to leave comments down below. Your feedback is important to us. Last week, optimism on Wall Street was mainly fueled by positive earnings reports and increased risk appetite. After inflation in the US exceeded 9%, traders assumed that the Fed would raise the interest rate by 100 basis points. Fed policymakers rushed to debunk such rumors. Fed officials spoke unanimously in favor of raising the key rate by 75 basis points. Even the well-known hawks calmed the market by confirming the 75 basis rate increase. Traders shrugged off fears of a more aggressive rate hike. Notably, the Bank of Canada raised the cash rate by 100 basis points not so long ago. Speculators are now focused on earnings reports. At the beginning of the week, several banks unveiled their quarterly results. Bank of America revealed a disappointing report, while Goldman Sachs posted a smaller than expected drop in the second quarter profit. However, the stock market turned euphoric following Netflix and Tesla's earnings reports. Last Tuesday, Netflix said it lost much fewer subscribers than expected, 970,000, versus the forecast reading of 2 million. The streaming company's shares jumped by more than 7% on this news, pushing the tech sector into green territory. Tesla cemented the success of tech stocks by posting adjusted earnings of 1.95% per share, beating their 1.81% a share average of analysts' estimates. However, there is a downside to positive earnings reports. Despite the fact that 5.1% of S&P 500 companies that have already unveiled their second quarter reports have posted earnings above expectations, it's nearly half the average of 9.5% of the prior 4 quarters, Refinitiv said. Not long ago, several banks reported a hiring freeze. After that, some big tech companies, including Microsoft and Google, followed suit. Tesla CEO Elon Musk added fuel to the fire, saying that high prices would hurt demand. On top of that, almost all companies published dismal third quarter earnings forecasts. Last week, the equity market closed in the red due to the shares of social media companies and a significant drop in oil prices. They dragged the leaders of the S&P 500 index into the negative zone as well. However, analysts were also concerned about a strong US dollar. Each percentage point of the year-on-year increase in the US dollar index translates to a 0.5 percentage point hit to S&P 500 earnings growth, analysts at Morgan Stanley estimated. About 40% of the S&P 500 revenue comes from foreign markets, FactSet noted. The tech sector scored the biggest gains in all sectors with 58% of revenue generated overseas, followed by commodities with 56%, while utility companies received only 2% of their revenue in the US. However, other analysts are not so pessimistic. They believe that a strong national currency may help mitigate the negative consequences of recession, so the country could go through it easier than others. Nevertheless, Bank of America and Deutsche Bank expect a decline in US GDP. According to their working definition, a drop in GDP for 2 consecutive quarters means that the US is in recession. Whether this is true or not, we will find out on Thursday. And now let's move on to stock indices. Like 2 other benchmark indices, the Dow Jones closed in the week on a negative note, losing 0.43% on Friday and dropping to 31,899. At the same time, judging by the weekly results, the shares of blue-chip companies, including the Dow, grew by 2% in a week. As for the new week, traders should be bracing for sharp fluctuations. On Tuesday, the US will publish the Consumer Confidence Index and data on new home sales. On Wednesday, the FOMC meeting will be in the limelight. On Monday, the probability of a 100 basis point rate hike totaled 9%. Thus, the Fed is likely to remain moderately hawkish, raising the interest by 75 basis points. At the same time, investors are much more interested in the Fed's economic projections. As the meeting is approaching, some economists stress that inflation has already peaked, and soon it will be declining. Yet others highlight global risks and the imminent recession. Former Treasury Secretary Larry Summers warned that there is a very high probability of a recession in the US. He also believes that the Fed is unlikely to engineer a soft landing. His comments came earlier than Thursday's release of preliminary second quarter GDP data. This report may confirm that the United States has already entered a recession, according to GDP indicator. Microsoft, Procter & Gamble, Chevron and Coca-Cola are projected to reveal their quarterly results. Analysts reckon that weaker than expected figures may trigger a new drop in the stock market. The S&P 500 declined by 0.93 and closed at 3,961 last Friday. During this week, the index added 2.6%, showing an average result among the three indices. As for the new week, analysts will shift their attention to the S&P 500 as they assess the impact of global factors on the US economy by the performance of this index. Some market strategists are confident that the worst is over. For example, Bank of America suggests that stock market investors should buy now, as pessimism is at dire levels. According to BofA, the S&P 500 will advance to 4,200 or by 6% from current levels. When the index approaches this high, it's better to sell. USD strength comes in at an improper time for corporates already facing margin pressure and increasingly weaker demand, Morgan Stanley said. Yet a strong US dollar, which affects the profit of S&P 500 companies focused on foreign markets, may eventually offset losses. The US dollar peaks of the past 40 years have been followed by rallies in the S&P 500, with the benchmark index climbing by an average of 10% in the next 12 months. Time will show whether this scenario will come true. The heavy tech NASDAQ demonstrated steady growth last week. On Friday, it lost 1.87% but gained 3.3% in the week. Stocks edged higher last week amid expectations of a less aggressive rate hike and increased risk appetite. Strong Netflix and Tesla earnings reports published the NASDAQ up by 3.1%. They also boosted optimism in the stock market that had been lasting for the week. Therefore, investors are now focusing on the earnings reports, as several tech giants are scheduled to reveal their quarterly results this week. In addition, European companies are also going to publish their reports. At the same time, a strong US dollar is posing risks to the NASDAQ, as it limits risk appetite even despite positive quarterly reports. The results of the Fed meeting are unlikely to somewhat surprise traders. However, everything is possible. Investors should be particularly alert to both the Fed meeting and the earnings reports. At the end of last week, the NASDAQ showed how much the results of individual companies could affect the index and the stock market as a whole. We have already mentioned how Netflix and Tesla reports fueled optimism on Wall Street. However, there have been negative reports as well. The main outsider was Snapchat. Its shares plummeted by 39% on Friday after a drop in advertising revenue hit in the company's second quarter earnings. Snap said changes to iPhone privacy, economic challenges, and increasingly tough competition for advertisers have significantly slowed revenue growth. Following this news, shares of large tech companies that are also engaged in online advertising, including Meta, Alphabet, Twitter, and Pinterest, sank by 3 to 7%. The earnings season is stirring up the market volatility. This week, even more companies are going to reveal their quarterly reports. Watch our video reviews and stay up to date with the latest market news. See you!